You are burning your life savings trying to time the market. Every tick of the Dow Jones is a trap designed to drain your brokerage account while you chase ghosts of profit. Last Tuesday, thousands of day traders lost their houses in a 30-minute flash crash they thought they could predict. They watched their portfolios evaporate in real time, victims of a false belief that charts and timing could beat the machine. Math tells a very different story. And wait until you see the third method I have for you later on. It is arguably the most powerful tool for wealth building, yet it requires absolutely zero effort on your part. So find a comfortable chair, maybe grab a glass of water, and let us get into the reality of market timing. Let us start with the first, and perhaps the most important realization you need to make. The market does not care about your intuition. Human beings are hardwired to avoid pain and seek rewards, which makes us terrible at investing. When the market crashes, your brain screams at you to sell to stop the bleeding. When it hits record highs, your brain screams at you to buy so you do not miss out on the party. This is called the fear-greed cycle. Think about a major event like the financial crisis in 2008. If you had panicked and pulled your money out in September of that year, you would have avoided some of the sharpest drops. But most people who pull out in a panic are too scared to buy back in when things start to recover. They miss the rebound. A study by Dalbar, a firm that tracks investor behavior, found that over a 20-year period, the average equity investor significantly underperformed the S&P 500 index. They underperformed because they could not sit still. They were constantly trying to time the market, jumping in and out, and paying the price and loss potential. The easiest way to start winning is to simply stop trying to beat the market at its own game. Just choose to be present. That alone puts you ahead of the majority of traders who are constantly guessing. Now, let us move to the second level of understanding, where we look at the high cost of missing out on the best days. You might think you can sit on the sidelines during volatile periods and then jump back in when things look safe. But the stock market does not announce its best days in advance. Often, the biggest gains happen immediately after the biggest losses. Consider data from JP Morgan Asset Management. They looked at the 20-year performance of the S&P 500 from 2001 to 2020. If you stayed invested the entire time, you would have earned a healthy annualized return of about 7.5%. That is a solid outcome. But here is the kicker. If you missed just the 10 best days during those 20 years, your return was cut nearly in half. If you missed the 30 best days, your return turned into a net loss. Think about that for a second. Missing just 30 days out of 5,000 trading sessions is enough to destroy your long-term success. Most of those best days happen during the middle of a bear market when you are most afraid to be invested. You see how the math forces you to stay put. Trying to avoid the bad days inevitably forces you to miss the good ones. If this is starting to click for you, hit the subscribe button so you do not miss the next deep dive into how money actually grows. Okay, remember how I mentioned there was a third method I was saving for you? This is the one that changes everything. It is the concept of dollar cost averaging, and honestly, it is the secret weapon for building wealth while you sleep. Instead of trying to guess when the price is low and when the price is high, you just commit to investing a set amount of money at regular intervals. Every 2 weeks, every month, it does not matter. Let us say you invest $500 every month, regardless of whether the market is booming or crashing. When the market is down, your $500 buys more shares because the price is lower. When the market is up, your $500 buys fewer shares. Over time, this averages out the cost of your investment. You stop stressing about the daily news cycles because you know you are building a larger position when things are cheap. This removes the emotional baggage entirely. There is no more sweating over a dip because a dip is just a sale price for your next automatic purchase. A study by the Schwab Center for Financial Research tracked the results of someone who perfectly timed the market versus someone who used dollar cost averaging over 20 years. The perfect market timer did perform slightly better, but the perfect timer is a fantasy. Nobody is perfect. When they compared the dollar cost averager to someone who consistently invested their money as soon as they had it, the difference in outcomes was negligible compared to the sheer peace of mind gained. You get to avoid the mental anguish and the high probability of missing those massive market defining gains. Once you see it this way, you truly cannot unsee it. You stop playing the game of luck and start playing the game of patience. So, let us recap. First, stop letting your emotions dictate your trades because the market thrives on fear and greed. Second, understand that missing just a handful of the best days in the market can ruin your 20-year outlook. And third, use dollar cost averaging to turn the market's volatility into a systematic advantage. That is the strategy that turns small, consistent contributions into significant wealth over time. It is boring, it is predictable, and it works. If you got value from this, share it with someone who is currently losing sleep over their portfolio and hit that subscribe button so you do not miss my next look into the mechanics of building financial freedom. And hey, if you really want to level up, think about what happens when you automate these contributions through your employer retirement plan or personal brokerage link. You take the decision making process out of your own hands, and that is where the magic really happens. See you in the next one. The reality of finance is that the loudest voices in the media are the ones least likely to help you succeed. They thrive on the drama of market swings because that drama keeps people glued to their screens, watching the commercials that pay their bills. Your goal is not to be a spectator in their show. Your goal is to be a participant in the growth of the global economy. Think about the largest companies on the planet. They are constantly innovating, hiring, and expanding. When you buy an index fund that tracks the broader market, you are buying a slice of that collective innovation. You are betting on the idea that humanity will continue to solve problems and create value. And historically, that has been the safest bet you could possibly make. It is far safer than betting that you can pick the exact right Tuesday morning to move your cash around. Keep that perspective as you look at your accounts. You are not playing a short term game. You are playing a long term game that spans decades, not days or weeks. Every time you feel that urge to check the prices, to look for a reason to sell, or to jump on a new hot trend, pause and remind yourself of the math. Consistency is the bedrock of wealth. It is not the flashy trades that make people wealthy. It is the quiet, boring, consistent contributions made year after year. It is the act of showing up when you do not want to, when the news is bad, and when everything feels uncertain. That is where the power is. That is how you win.